We okay to go, Deb? Thank you. Morning, everybody. I'd like to call this meeting of the FDIC Board to order. We need a sunshine motion. Could I please have a sunshine motion?
So moved.
Thank you. And a second?
Second.
Thank you. All those in favor, please say aye.
Aye.
Opposed? The motion is adopted. We have several items on the summary agenda this morning. Are there any questions or comments on the summary agenda? I'd simply note that I have two statements for the record in regard to items on the summary agenda. One on the final rule to revise the Section 19 regulation, and one on a notice of proposed rulemaking on the Financial Data Transparency Act. I'd simply ask for those statements to be included in the record. There's no further comment or question. May I have a motion to approve the summary agenda?
So moved.
Thank you. And a second?
Second.
Thank you. All in favor, please say aye.
Aye.
Opposed? The motion is adopted. We have several items on the discussion agenda this morning. First, we'll hear from staff regarding a notice of proposed rulemaking for proposed revisions to the FDIC regulations on broker deposits. Rayanne Miller, Tom Lyons, Vivek Kare, and Chantel Hernandez will present the case.
Good morning, Chairman Gruenberg and members of the board. Today, FDIC staff recommends for board consideration a notice of proposed rulemaking seeking comment for 60 days on proposed revisions to the FDIC's broker deposit regulations. Staff believes that the proposed regulations would help strengthen the important prudential protections of the broker deposit rule required by statutory restrictions and reduce the very serious risks that broker deposits pose to less than well-capitalized insured depository institutions, or we'll be referring them to as IDIs, and the Deposit Insurance Fund. Specifically, the proposed changes would, one, simplify certain definitions under the current regulations to reduce operational challenges and reporting burdens on IDIs. Number two, help ensure consistent and uniform reporting of broker deposits. And three, strengthen the safety and soundness of the banking system by ensuring that less than well-capitalized institutions are restricted from relying on broker deposits to support risky rapid growth. To this end, the proposed rule would revise the deposit broker definition to make it more straightforward for IDIs to apply while restoring important safety and soundness considerations. The proposed rule would also eliminate the exclusive deposit exception. As to the primary purpose exception to the deposit broker definition, the proposed rule would, one, amend the analysis for primary purpose applications, including adding new factors for review, and number two, amend two of the designated business relationships that qualify for the exception, and number three, amend the notice and application processes for the exception. The proposed rule would also clarify when an IDI can regain its lost agent institution status under the limited exception for reciprocal deposits. I'm now going to provide a brief overview of the broker deposit restrictions. So Section 29 of the Federal Deposit Insurance Act imposes restrictions on a less than well-capitalized IDI from accepting funds obtained directly or indirectly by or through any deposit broker for deposit into one or more deposit accounts, referred to as brokered deposits. Section 29 also provides that the FDIC may impose, by regulation or order, additional restrictions on the acceptance of broker deposits as the FDIC may determine to be appropriate. Section 29 of the FDI Act does not directly define a brokered deposit, rather it defines a deposit broker and sets forth various exclusions to this definition. A person meets the deposit broker definition under Section 29 of the FDI Act, as relevant here, if it is engaged in the business of placing deposits or facilitating the placement of deposits of third parties with insured depository institutions. Because Section 29 of the FDI Act does not directly define broker deposits, What is considered a brokered deposit turns on who is considered a deposit broker. I'm now going to turn it over to Tom Lyons, Associate Director of Risk Management Policy, who's going to discuss the need for rulemaking and the recommended proposed changes. Tom?
Thank you, Rayanne. The FDIC's mission is to maintain stability and public confidence in the nation's financial system by, among other things, overseeing financial institutions for safety and soundness and ensuring deposits. As detailed in the preamble to the proposed rule, the FDIC has historically found significant reliance on broker deposits increases an institution's risk profile, particularly as its financial condition weakens. In December 2020, the FDIC issued a final rule that established a new framework for analyzing whether certain deposit arrangements qualify as broker deposits. Since the 2020 rule took effect, staff has identified certain issues that this proposal intends to address. More specifically, it is staff's view that this rulemaking is necessary for the following reasons. First, under the law, less than well-capitalized IDIs are restricted from accepting broker deposits. However, certain deposit arrangements that would have been viewed as brokered prior to the 2020 final rule are no longer being classified as brokered, even though such deposits present the same risks as deposits that are considered brokered. In turn, this gap raises the risk that these IDIs could rely on less stable deposits to grow rapidly without corresponding risk controls, and therefore weaken IDIs and the banking system, and in turn, expose the Deposit Insurance Fund to increased losses. Second, IDIs have had difficulty understanding and applying the current rule, particularly as to the involvement of additional third parties within a deposit arrangement that meet the deposit broker definition, and thus are misreporting broker deposits as non-brokered. While well-capitalized IDIs are not subject to the broker deposit restrictions, all IDIs are responsible for understanding the rule and submitting accurate call reports. Third, with respect to the limited exception for reciprocal deposits, the current regulation allows IDIs to accept a limited portion of reciprocal deposits from classification as broker deposits, as long as the IDI qualifies as an agent institution. However, the current regulation does not address how an IDI that lost its agent institution status could later regain the status to once again qualify for the limited exception. Now I will turn to the proposed changes, starting with the proposed amendments to the deposit broker definition. The proposed rule would amend the definition of a deposit broker by 1, combining the placement and facilitation prongs in the current rule, 2, replacing the prong related to matchmaking activities with a straightforward prong related to deposit allocation activities, and 3, adding a new prong related to fees. On placement and facilitation. Under the current rule, staff has observed that some IDIs have been misapplying the placing and facilitating parts of the deposit broker definition. Staff believes that by combining the placing and facilitating prongs, the proposed rule would better align with the statutory text and would make it simpler for IDIs and other stakeholders to apply accurately. On deposit allocation, the proposed rule would also replace the matchmaking activities prong of the facilitating definition with a deposit allocation provision that would make the rule's application more operationally workable. The FDIC has observed a number of IDIs and other stakeholders have incorrectly determined that third parties are not deposit brokers by misapplying the matchmaking activities definition, notwithstanding the FDIC's efforts in providing clarifications through a published policy statement and questions and answers related to the broker deposit rule. As such, the proposal would eliminate the matchmaking definition and would replace it with a more understandable provision that covers a third party that proposes or determines deposit allocations through the operation or use of an algorithm or functionally similar program or technology. In addition, the deposit allocation prong would not exclude third parties that provide these services between affiliated entities, as recent experience has demonstrated that third parties do propose or determine deposit allocations at both unaffiliated and affiliated IDIs, and these deposits, when uninsured, do not seem to act in a more sticky manner just because there is an affiliated relationship. On fees, the proposed rule would also add fees as a consideration to the deposit broker definition. Specifically, if the person has a relationship or arrangement with an IDI or customer where the IDI or the customer pays the person a fee or provides other remuneration related to the placement of deposits at an IDI, it meets the deposit broker definition. So with that, I'll turn it over to Vivek Tarre, Senior Counsel, to now discuss changes to the exclusive deposit arrangement exception and the primary purpose exception.
Thank you, Tom. The proposed rule would also eliminate the exclusive deposit placement arrangement exception under the current rule and restore the broker deposits regulation to apply to third parties that are involved in placing deposits at only one IDI. Under the current rule, the broker deposit restrictions do not apply where a third party that would otherwise be a deposit broker has an exclusive deposit placement arrangement at only one IDI. The practical result is that an IDI could rely on a single unaffiliated third party to obtain all of its deposits without those deposits being considered brokered, even if the IDI became less than well capitalized. Further, a less than well capitalized depository institution could form multiple exclusive relationships without any of those deposits being reported as brokered. The proposed rule would remove the current exception as it is a potential workaround to the statutory prohibition on less than well capitalized IDIs receiving brokered deposits. The proposed rule would also make a change to the primary purpose exception. Section 29 of the FDI Act and the broker deposit regulation provide an exception to the definition of deposit broker for an agent or nominee whose primary purpose is not the placement of funds with depository institutions. While the proposed rule would retain the current analysis of the third party's relationship with its customers, staff believes that the analysis should also consider the third party's relationship with the IDI. Under the proposal, the primary purpose exception would apply when an agent or nominee whose primary purpose in placing customer deposits at IDIs is for a substantial purpose other than to provide a deposit placement service or FDIC deposit insurance with respect to a particular business line. As part of this proposal, previously approved primary purpose exception applications and notices filed under the current rule would be rescinded. With respect to the application process for a primary purpose exception, the proposed rule would limit eligible applicants to IDIs and make it easier for IDIs to correctly rely upon a primary purpose exception once granted. The current rule allows third parties and IDIs on behalf of third parties to apply for a primary purpose exception. Staff has found, among other things, that when applications are filed by third parties, they often do not provide complete information on all parties in the arrangement, including the IDIs receiving deposits in the arrangement. As such, the proposed rule would require each IDI that wishes to rely on an exception to file an application with the FDIC for the specific arrangement with the applicable third party. In addition, the proposed rule would supplement the contents of the primary purpose exception application process by requiring applicants to provide additional information that would be needed to analyze whether a third party meets the exception under the proposed interpretation. Staff believes that adding additional factors to the current list is necessary to fully consider the third party's purpose in placing deposits and determine whether it is eligible for the primary purpose exception. Chantel Hernandez, counsel in the legal division, will now discuss the proposed changes to the 25% test and the enabling transactions test.
Thank you, Vivek. The proposed rule would amend and rename the 25% test and eliminate the enabling transactions test. The current rule provides a primary purpose exception if the agent or nominee Thank you. The current rule provides a primary purpose exception if the agent or nominee places less than 25% of its assets under administration for a particular business line at IDIs. Third parties relying on the 25% test or IDIs on its behalf must file a notice with the FDIC. Third parties relying on the 25% test tend to be broker-dealers or investment advisors. Under the current rule, for IDIs to report the deposits as non-brokered, there must be no other party in the arrangement that meets the definition of a deposit broker. Since the current rule became effective, it has been staff's experience that some IDIs have inaccurately determined the activities of additional third parties and determined that they did not meet the deposit broker definition, despite the activities constituting matchmaking activities under the current rule. This has likely led to some IDIs inaccurately reporting broker deposits as non-brokered. To align with the proposed analysis of the primary purpose exception, and to help determine whether any additional third party meets the deposit broker definition, the proposed rule would revise the 25% test and rename it the broker-dealer sweep exception. The proposed exception would be available only to SEC-registered broker-dealers and investment advisors and require that no more than 10% of the entity's total assets under management for its customers in a particular business line is placed into non-maturity accounts at one or more IDIs. Staff views placing less than 10% of customer funds at IDIs as more indicative that the primary purpose is to temporarily safekeep customer funds awaiting investment than a broker-dealer or investment advisor providing placement services or deposit insurance. To rely on this proposed exception, IDIs would be required to submit a notice containing certain information as detailed in the NPR. In an effort to ensure that the FDIC has the ability to properly scrutinize the role of additional third parties as part of sweep programs, the proposal would also create an application process for IDIs that wish to invoke the exception when additional third parties are involved in the arrangement. The proposed rule would also eliminate the enabling transactions test and its associated notice and application process. Prior to the current rule, the FDIC did not distinguish between acting with the purpose of placing deposits for other parties and acting with the purpose of enabling other parties to use deposits to make purchases. The 2020 final rule distinguished these two purposes and created a primary purpose exception for third parties that place deposits to allow their customers to enable transactions. However, under the proposed rule's revision to the primary purpose exception analysis, many of these third parties would not satisfy that exception because simply placing deposits into transactional accounts would not, by itself, demonstrate that the substantial purpose of the deposit placement arrangement is for a purpose other than providing deposit insurance or a deposit placement service. Accordingly, the proposal would eliminate the enabling transactions test and its corresponding notice and application process and rescind current notices and applications under the current test. I will now turn it back to Tom Lyons to discuss the proposed changes to the limited exception for reciprocal deposits.
Thank you, Chantel. The proposed rule would clarify how an IDI that lost eligibility for the limited exception for reciprocal deposits could regain its eligibility. Under the current rule, an IDI that qualifies as an agent institution can accept a limited amount of reciprocal deposits from being treated as brokered. Section 29 of the FDI Act and the current rule set forth the requirements for IDIs to maintain agent institution status. However, the current rule does not address how an IDI that lost its agent institution status could regain that status. The proposed rule would provide paths for an IDI to regain agent institution status that are tailored to the definition of an agent institution. And with that, I'm going to turn it back to Rayanne for concluding remarks.
Thanks, Tom. This concludes our remarks, so we're very happy to entertain questions or comments at this time. Thank you.
No, thank you very much. That was very helpful. I'll have a statement and then turn to the other members of the board. The FDIC Board is considering today a proposed rule that would revise the FDIC's regulations to update and clarify provisions related to the definition of a deposit broker. Section 29 of the Federal Deposit Insurance Act imposes restrictions on a less than well-capitalized insured depository institution from accepting funds obtained directly or indirectly by or through any deposit broker for deposit into one or more deposit accounts. Section 29 also provides that the FDIC may impose by regulation or order additional restrictions on the acceptance of broker deposits as the FDIC may determine to be appropriate. Section 29 is aimed at addressing longstanding concerns regarding brokered deposits. A bank's use of brokered deposits often raises its risk profile because such deposits could facilitate a bank's rapid growth in risky assets without adequate controls. Once problems arise, a problem bank could use such deposits to fund additional risky assets to attempt to grow out of its problems, a strategy that ultimately increases losses to the deposit insurance fund when the institution fails. And finally, brokered and high-rate deposits are sometimes considered less stable because deposit brokers on behalf of customers or customers themselves are often drawn to high rates and prone to leave the bank quickly to obtain a better rate or if they become aware of problems at the bank. Historically, and as described in the preamble to the proposed rule, various studies and reports have shown that reliance on broker deposits is associated with a higher probability of a bank's failure and higher loss rates to the deposit insurance fund. Further, more recent events have also underscored the uncertain nature of third-party funding arrangements. Experience has shown that they can be highly unstable, with either the third party or the underlying customers moving funds based on market conditions or other factors. These arrangements can also be prone to other forms of disruption, such as the potential or actual insolvency of the third party, as was recently demonstrated by the bankruptcy of Synapse Financial Technologies. Synapse, sometimes referred to as a fintech middleware company, was a deposit broker that facilitated customer deposits for various fintech companies looking for banking services with insured depository institutions. The FDIC, the Office of the Comptroller of the Currency, and the Board of Governors of the Federal Reserve recently issued a statement on third-party deposit relationships that reflects supervisory concerns related to arrangements like Synapse. The FDIC is also evaluating additional rulemaking to address the risks to depositors presented by these types of third-party deposit arrangements. Moreover, the rapid growth of such deposits without corresponding growth in risk management practices can expose banks to operational, liquidity, and legal risks. A key concern is that some of these funding arrangements are not considered brokered under the current broker deposit regulations, even though they represent the same risks as broker deposits. With respect to the current regulations, in December of 2020, the FDIC Board adopted a rule that established a new framework for analyzing whether certain deposit arrangements qualify as broker deposits. Among other things, the 2020 final rule narrowed the types of deposit-related activities that are considered brokered and also expanded the types of business relationships that are eligible to be accepted from the broker deposit definition. Unfortunately, the FDIC's experiences since the 2020 final rule have confirmed some of the risks of this narrower coverage. For example, the crypto company Voyager was not considered a deposit broker, and therefore deposits it placed in its partner bank were not considered brokered merely because it had an exclusive deposit placement arrangement with one bank. Such exclusive deposit placement arrangements were specifically excluded from the definition of a deposit broker under the 2020 final rule, even though they plainly met the definition of deposit broker. As a result, when Voyager failed in 2022 it created the same legal, operational, and liquidity risks for its partner bank as if it had been classified as a deposit broker. Specifically, Voyager's partner bank experienced several risks related to Voyager's sudden bankruptcy, including but not limited to legal risk related to customers' lack of access to their funds for several weeks, earnings risks related to legal fees and increases in interest expense as a result of the loss of the low-cost Voyager deposits, and liquidity risks related to the need to replace the Voyager deposits once the bankruptcy court cleared release of the funds to end users. The concern here is that less than well-capitalized banks may seek these exclusive deposit placement arrangements as their condition is deteriorating without being subject to the limitations on broker deposits, even though the risk is the same. First Republic Bank, which failed in May of 2023 after contagion effects from the failure of Silicon Valley Bank sparked a significant run on uninsured deposits, is another example of problems with narrowing the coverage of the rule. This run included a significant outflow of sweep deposits from an affiliate of the bank, and in particular, uninsured affiliated sweep deposits. This case suggests that affiliated sweeps, particularly those that are uninsured, were no more sticky than unaffiliated sweeps, contrary to a provision in the 2020 final rule that expressly exempts affiliated sweeps from being considered brokered. In addition, despite industry outreach by the FDIC, there have been a number of challenges with entities understanding certain provisions of the 2020 final rule. For example, under the current rule, any third party may immediately invoke a primary purpose exception from being considered a deposit broker by simply submitting a notice indicating that it places less than 25% of customer assets under administration for a particular business line at more than one bank. The FDIC has observed that some banks receiving deposits through a sweep arrangement have incorrectly relied on a notice submission for the 25% test, despite the involvement of an additional third party that meets the broker deposit definition, the deposit broker definition. In some cases, the bank reports the sweep deposits as non-brokered, relying solely on the presence of the notice submission without seeking the appropriate documentation to conduct its own due diligence to determine whether the additional third parties involved are deposit brokers. In turn, this has caused some deposits that meet the broker deposit definition under the 2020 final rule to not be correctly reported as brokered on banks' consolidated reports of condition and income, or the call report. If left unchanged, this underreporting of broker deposits could have serious consequences for banks and the Deposit Insurance Fund. Such underreporting impedes the ability to evaluate the extent of reliance on broker deposits and the effects on a bank's risk profile for supervisory and deposit insurance pricing purposes. Moreover, the FDIC is concerned that these issues expose banks individually and the banking system more broadly to the type of risk that broker deposit restrictions are intended to address, namely that a less than well-capitalized institution could rely on less stable third-party deposits for rapid growth that may weaken the safety and soundness of banks and the banking system and expose the FDIC to increased losses. Further, the 2020 final rule provides a primary purpose exception for any third party that is, quote, enabling transactions. The exception is immediately granted when a third party submits a notice indicating 100% of customer funds are placed into transactional accounts and no fees, interest, or other remuneration is provided to the depositor. The enabling transaction test has allowed many third parties to receive a per se primary purpose exception without demonstrating that the primary purpose of the deposit placement arrangement is for a purpose other than providing deposit insurance or a deposit placement service. In practice, there is no meaningful difference between a third party's purpose in placing deposits to, quote, enable transactions and placing deposits to access a deposit account and deposit insurance. The changes to the broker deposit rule contained in this notice of proposed rulemaking being considered by the board today address the fundamental considerations of the relationship between a bank, a depositor, and a third-party intermediary, and the risks the relationship may pose. The changes would help strengthen the important prudential protections of the broker deposit rule required by statutory restrictions and reduce the very serious risks that broker deposits pose to less than well-capitalized banks and the Deposit Insurance Fund. This proposed rule would alleviate many of these concerns by amending the definition of deposit broker to, among other things, eliminate the automatic exemption for affiliated sweeps that are using additional third parties, and also cover fee-based arrangements. In addition, concerns would be addressed by eliminating the exclusive deposit placement arrangement exception. It would also eliminate the primary purpose exception for enabling transactions and would revise the 25% test applicable to any third party to a modified 10% test that only applies to broker-dealer or investment advisor sweeps. The proposed rule would change the notice and application requirements for the primary purpose exception to apply only to banks, which, among other things, would help address the underreporting of broker deposits. All of these changes would significantly enhance the protections of the brokered deposit rule. In addition, the proposal would reduce operational challenges and reporting burdens on insured depository institutions by simplifying certain definitions, help ensure uniform and consistent reporting of broker deposits, and strengthen the safety and soundness of the banking system. I am pleased to support this proposed rule and its publication for a 60-day comment period. We look forward to receiving thoughtful comments on the proposal, and I would like to thank the staff of the FDIC for their very thoughtful and diligent work on this rulemaking. Thank you.
Thank you, Chairman. I expressed my high-level concerns regarding the broker deposits framework last week. The term broker deposits encompasses many different types of deposits with very different characteristics and risks. The deposit landscape has become too complex to continually decide which arrangements are brokered and which are not in a fair and risk-sensitive way. And I am generally skeptical of sweeping rules that cut banks off from certain types of funding as their condition deteriorates, as is the case with broker deposits. I will vote against the proposal. Revamping this rule is a major undertaking that, in my opinion, is a poor use of our time and resources. While I disagree with many provisions in the proposal, I will focus my statement on a few specific ones. To start, I strongly disagree with the revised approach to the primary purpose exception. The statute is quite clear. If a person's primary purpose is something other than the placement of deposits, the person is not a deposit broker. For example, a prepaid card network places its customer funds in a bank not because it is in the business of helping customers open or put money in bank accounts, but because it needs the banking system to move money from place to place. The prepaid card network's primary purpose is to provide customers a mechanism to make payments and transactions, not to help customers place their funds at banks. The 2020 rule created a new standard and framework for implementing the primary purpose exception. Prior to the 2020 rule, the FDIC did not have a consistent standard or framework. Instead, the agency generally decided whether to apply the exception based on a subjective value judgment of the underlying motivation behind the deposit arrangement at the time the arrangement was first presented before the FDIC. The proposal generally reverts back to the pre-2020 approach, though using different words and with a different process. The proposal greatly expands the 2020 rules application process, adding more subjectivity to the process, and critically makes adjustments to the standard by which the FDIC analyzes whether an entity qualifies for the exception. Under the current rule, the FDIC looks at whether the primary purpose of the entity's business relationship with its customers is the placement of deposits, an easy-to-understand analysis that is consistent with the plain meaning of the statute. The proposal would instead analyze whether the primary purpose of an entity's relationship with the bank is for a substantial purpose other than, quote, a deposit placement service or FDIC deposit insurance, end quote. This new standard is harder to understand, harder to meet, and further removed from the words of the statute. The proposal also requires that, in order for deposits to qualify under the primary purpose exception, unless the deposits qualify for one of the limited designated exceptions, every bank that accepts such deposits will have to apply separately to the FDIC. This means, for example, that if an entity works with 10 banks, every single bank would need to apply individually and receive approval from the FDIC to treat the arrangement as non-brokered under the primary purpose exception. Given the number of deposit arrangements that may be newly scoped in by the rule, the more subjective standard by which the FDIC will judge applications, and the lack of grandfathering of existing arrangements, I suspect an enormous avalanche of applications may hit the FDIC on day one, which the agency is completely unequipped to process in any sort of timely or efficient manner. I also disagree with eliminating the enabling transactions designated exception. As an example, as noted earlier, the primary purpose of a prepaid card network is to provide customers a mechanism to make payments, whereas placing deposits is an ancillary but necessary part of the business. I also disagree with replacing the 25% test. I do not think it is accurate to conclude that the primary purpose of a company that collects funds from customers and, for example, places 12% of those funds at banks is the placement of deposits, given that 88% of those funds are placed elsewhere. The proposal would also add a new criterion providing that a person is a deposit broker if that person receives, quote, a fee or other remuneration in exchange for or related to the placement of deposits, end quote. This is a broad, sweeping criterion that, if applied literally and consistently, would capture a wide range of businesses that have any involvement in deposit arrangements. However, the preamble also notes that passive listing services would not be captured by the proposal because the fees they charge to customers are for, quote, information on the rates gathered by the listing service, end quote, and the fees they charge to banks are for the, quote, opportunity to list or post the IDI's rates, end quote. I think it is reasonable to create a broker deposits regime that does not include listing services, but if a listing service is not accepting fees in exchange for or related to the placement of deposits, then I am not sure who is. Why would the proposal establish a sweeping new criterion for a deposit broker, but then exempt a deposit arrangement that seems to obviously meet it? Two explanations jump out to me. First, I think many supervisors believe listing service deposits are an important liquidity source for banks that are subject to broker deposit restrictions and do not want to cut banks off from that potential safety valve. Second, I am confident that if listing service deposits were first exempted from the rule in 2020, there would not be a carve-out in the proposal, and I think this reveals the true motivation underlying much of this proposal. For those reasons and others, I will vote no. While I think certain refinements of the 2020 rule might be warranted based on our experience over the past 3.5 years, the proposal goes too far. Nonetheless, thank you to staff for their continued work on this issue over many years.
Thank you. Director McKiernan.
Thank you, Mr. Chairman. I've become a bit of a bore in making the case for us to give reasons for our rules. We got to make a compelling case. I'm reminded of our in-game proposal, where we didn't even offer the most cursory of rationales for some very significant design decisions. And as we come to this rule, I think it's important to kind of step back and think, well, the question here is not whether broker deposits present risks. The question is whether the deposit types that we are going to recharacterize under this proposal as broker deposits present the same or similar risks as those deposits currently classified as broker deposits. And on that score, very little evidence here in the preamble. On the 25% test, for example, which we are going to narrow, we say simply, lowering the threshold to 10%, quote, may reduce potential risk to safety and soundness. On the elimination of the enabling transactions test, the proposal flatly and simply asserts, quote, the FDIC believes there is no relevant difference between an agent or nominee's purpose in placing deposits to enable transactions and placing deposits to assess the deposit account. No evidence here about the risks. I think really, with respect to the enabling transaction test, what's motivating this, I think, is a concern about bank partnerships with fintechs. I mean, Chairman went on about Voyager and Synapse, and certainly there are some real risks with those arrangements, but the broker deposit regime is not fit for purpose to regulate those risks. We need to have risks actually tailored to those. I guess going kind of back to this point on the absence of really a fact-based case for our changes here, our 2011 study that is, I think, the basis for much of the concern in broker deposit space and how we do the taxonomy here, it's pretty old. It's pretty dated. The market's changed a lot, especially with respect to fintech partnerships. I think we really need to think about whether to revisit the empirical basis for our framework here. And finally, another pet issue of mine, I think maybe some others on this board also share this concern. We really need to think about the pros and cons of removing per se exceptions and having application processes. Certainly, I understand that we as regulators like to have discretion, but that discretion comes at the cost of enabling the lawyer shakedown, right? Now we have lawyers that are going to be involved in all these applications, and I share the Vice Chair concern about whether we really are in a position to deal with the flood of applications we're going to get with respect to some of these primary purpose exceptions. So certainly think that there's probably a good case to revisit the 2020 rule to think about whether we could address some of these concerns that Tom raised around third parties, multiple third parties being involved in relationships. So I think there's some room for improvements here, but if we're going to have changes, we really need to make a case for those, so I'll not be able to support the proposal. Thank you, Mr. Chairman.
Thank you. Director Sue?
Thanks, Chairman. So I don't have any questions for staff. I'm going to support the NPR. I've got a broader statement on deposits, which I'll make after the RFI, the discussion on the RFI for deposits. I'll save it for that. Thanks.
Okay, thank you. Director Chopra?
Well, thank you all for the presentation. I just wanted to underline one aspect, which was our experience with First Republic. And it experienced a significant run on uninsured deposits in the wake of Silicon Valley Bank's failures. Some of the uninsured deposits that had significant outflows were affiliated sweep deposits, as was previously mentioned. I just wonder if you could walk through and explain how the 2020 rule treated affiliated sweep deposits and how the First Republic experience informs the changes we're making.
So I'll start with the response. So the 2020 rule included in the deposit broker definition a, quote, matchmaking activities prong. And this prong was intended to cover third-party deposit allocation service providers when an additional third party is used to place deposits between, say, in this case, a broker-dealer and an IDI, essentially the definition excluded specifically affiliated parties. So they sort of got a special exception for affiliates that others did not benefit from. And I would say the way the First Republic example informs our case is it suggests that uninsured, in fact, there was more than just uninsured affiliate sweeps that were that flew out, that outflowed. Some even insured affiliated sweeps flew out. So the way we view it is that affiliateds, in this case at least, were no more sticky than unaffiliated sweeps, and in fact seem to be far less sticky than unaffiliated sweeps. So that was contrary to that exception I just described with respect to the matchmaking activities prong. And I would go back to some of the things the chairman said, and we also said in our remarks that we believe that the matchmaking definition is hard for the IDIs to understand. They have misapplied the definition. Essentially, we have seen institutions see the primary purpose notice that's published on our website and rely on that without either getting additional information to determine whether an additional third party is involved. But we've also seen situations where the third parties refuse to provide those documents to the IDI, and that's a problem because they need and they are responsible for reporting properly on the call report. So there's been some significant concerns related to that matchmaking definition.
Can I ask, there was a pretty strange part of the 2020 rule, which was that there was an exemption for exclusive placements by a third party of demand deposits. But if they were brokering CDs, they did not enjoy that. Where did we kind of come up with that?
That was added to the regulation as part of the 2020. Where do we come up with it was really not our supervisory experience. The Director McKiernan referred to the 2011 study. We also updated that study in 2019. At that time, we didn't specifically identify or focus on one party versus two party, because that wasn't an issue. Whether, prior to 2020, whether there was one party or two, we viewed the risk the same. And the concern is with a program manager, whether it's with one bank or two, driving funds to a bank rapidly, typically rapidly, not always. We saw rapid growth. Chairman talked about a recent example where we saw some volatility, unpredictability, and that's really what we've observed with the project manager. And whether it's one or two, those same behaviors can occur. And he talked about Voyager. So Voyager was a crypto company, and it placed deposits on behalf of customers in one bank that were sort of free balances that were not being invested in crypto. And that was not considered a broker deposit. It was rather large for this institution. It wasn't its largest relationship, but when suddenly that company was disrupted, whether it was that partner bank or two, it had the same type of problem. So the chairman talked about some of the legal, operational, liquidity risk because they had to replace that deposit ultimately.
I'm sorry to jump in, but I hear you loud and clear that there may not be a big difference in the risk profile if they're placing with one versus multiple. I think what I'm trying to highlight is that there is this exemption in the 2020 rule for demand deposits that were exclusive. The same logic, which is a weird logic, would also apply to brokered deposits. I think at the bottom line of this, there's a lot of indicia that the 2020 rule was arbitrary and capricious. It was not really based on a strong fact base at all. It created a massive exemption for a whole set of risky deposits, and it's very important that we rescind and replace that. I think if challenged under the Administrative Procedure Act, a court would set it aside. So I'm glad that we're fixing this, and I'm pleased to support it.
Thank you. Are there any other questions or comments from the board? If none, may I have a motion to approve the resolution regarding proposed revisions to the FDIC's regulations on broker deposit restrictions?
So moved.
Thank you. And a second?
Second?
Thank you. I'll now call the roll for the vote on the resolution. I vote aye. Vice Chairman Hill,
No.
Director McKiernan,
No.
Director Sue,
Aye.
Director Chopra.
Aye.
The motion is adopted. Thank you all very much, and thank you to the staff for your very helpful presentations. Next on the agenda, we'll hear from staff on a notice of proposed rulemaking regarding amendments to the regulation governing parent companies of industrial banks and industrial loan companies. Rayanne Miller, Sandy Macias, Anne Marie Boyd, and Jonathan Miller will present the case. I see Jim Anderson's at the table, too.
Good morning. We are here to present a notice of proposed rulemaking, or NPR, to amend Part 354 of the FDIC Rules and Regulations, titled Parent Companies of Industrial Banks. Part 354 governs parent companies of industrial banks and industrial loan companies. Part 354 currently applies to each deposit insurance or merger approval or non-objection to a change in control if the action would result in an industrial bank becoming a subsidiary of a company not subject to consolidated supervision by the Federal Reserve, referred to in the regulations as a covered company. The proposal draws upon the staff's experience since the issuance of Part 354 and addresses supervisory concerns with respect to certain types of business models. The NPR proposes amendments covering three key areas: the scope of the rule, the role of written commitments and agreements with respect to how the FDIC evaluates the applicable statutory factors, and how the FDIC views captive or shell business models. I will discuss the first two areas, and then Sandy Macias, my colleague in RMS, will address the final area. First, the proposal would revise the scope of Part 354 to 1, include conversions from a federal savings association to a proposed industrial bank under Section 5 of the Homeowners Loan Act. 2, ensure that a parent company of an industrial bank would be subject to Part 354 following a change in control at the parent company or a merger in which the parent company is the resulting entity. 3, provide the FDIC the regulatory authority to apply Part 354 to other transactions that would result in an industrial bank becoming a subsidiary of a covered company. The proposed revisions are intended to ensure the FDIC has the ability to consistently apply Part 354 to all types of industrial bank filings, and that covered companies can and will serve as a source of strength for an industrial bank, consistent with the requirements of Section 38 of the FDI Act. Second, the proposed amendments would clarify the relationship between written commitments and the FDIC's evaluation of the statutory factors. Specifically, entering into parent company or capital and liquidity maintenance agreements or agreeing to non-standard conditions are not, in and of themselves, sufficient to ensure regulatory approval of an application or transaction. The proposed rule clarifies, consistent with the FDIC's long-held and publicly stated position, that while written agreements will be taken into account as part of the FDIC's consideration of the filing, they do not replace any statutory factor applicable to the filing and will not necessarily lead to the favorable resolution of the statutory factors where the facts and circumstances are otherwise unfavorable. In sum, depending on the facts and circumstances, an application may present fundamental challenges to a favorable finding on one or more statutory factors, notwithstanding the applicant's willingness to enter into the written commitments required by Part 354. I will now turn to Sandy to discuss the particular supervisory concerns that arise with respect to certain types of business models.
Thank you, Anne Marie. Since the issuance of Part 354, the FDIC has received a limited number of filings for prospective industrial banks that have contemplated specialty or limited purpose business models, including those where the operations of the proposed industrial bank would be closely connected to or reliant on the operation of the parent company or its affiliates, referred to here in the proposal as shell or captive structures. While many of the existing industrial banks supervised by the FDIC, most of which were approved prior to the Great Recession, are closely integrated with their parent organizations, they typically maintain adequate capital, have sufficient liquidity, and reflect satisfactory risk profiles. However, managerial, financial, and overall safety and soundness concerns are heightened when an industrial bank substantially relies on the parent company and its affiliates for primary business operations, including, but not limited to, exclusive reliance on the parent for sourcing business, conducting key operational elements such as underwriting, administering, and servicing customer accounts or relationships, and obtaining a wide range of critical business support services. In shell or captive structures, the industrial bank's operations and condition may be vulnerable to any financial distress or operational disruptions at the parent company or any affiliates that provide key services to the industrial bank. Further, the heavily integrated relationship between the industrial bank and the parent organization results in significant concentration risks that are typically not present in traditional community bank operating structures. The proposed amendments to Part 354 include considerations aimed at identifying shell or captive structures and presumptions the FDIC will apply once it is determined such a structure is proposed by an applicant. The NPR proposes a review of each filing covered by Part 354 on a case-by-case basis, including the facts and circumstances presented within the context of the applicable statutory factors, in order to determine the degree to which the industrial bank will have an independent board and management team, a business model that is viable on a standalone basis, and franchise value that is independent of the parent company and its affiliates. The FDIC would also closely assess whether any proposal involving a business model where there is significant degree of dependence on the parent company or affiliates, particularly with respect to the primary business functions of the proposed institution, would appropriately serve the convenience and needs of the community. The proposed amendments would provide that an industrial bank will be presumed to be a shell or captive institution, which may weigh heavily against a favorable finding in connection with one or more of the statutory factors. If the industrial bank A could not function independently of the covered company, B is significantly or materially reliant on the covered company or its affiliates, or C serves only as a funding channel for an existing covered company or affiliate business line. An applicant may seek to rebut the presumption of shell or captive status in writing. The proposal to expand Part 354 to include these considerations is intended to provide increased transparency regarding how the FDIC evaluates potential risks and concerns presented in an industrial bank filing. The notice of proposed rulemaking asks questions and seeks public comment on all aspects of the amendments. And with that, we're happy to take any questions or comments. Thank you.
Great, thank you very much. That was very helpful. I have a statement, and then I'll turn to the other members of the board. Today, the FDIC Board is considering a notice of proposed rulemaking to revise Part 354 of the FDIC Rules and Regulations regarding parent companies of industrial banks and industrial loan companies. The FDIC adopted Part 354 in December of 2020 in order to formalize its framework for supervising industrial banks and mitigating risk to the Deposit Insurance Fund. The rule requires certain conditions and written commitments in situations that would result in an industrial bank becoming a subsidiary of a company that's not subject to consolidated supervision by the Federal Reserve. It's referred to in the regulation as a covered company, and I'll use that term. The rule also ensures that a covered company that owns or controls an industrial bank serves as a source of financial strength for the industrial bank, consistent with Section 38A of the Federal Deposit Insurance Act. The proposal before the FDIC Board today is a revision of the current rule and draws upon the FDIC's experience since the issuance of Part 354 and its supervisory concerns with respect to certain types of business models. As noted in the preamble to the Notice of Proposed Rulemaking, the FDIC has concerns regarding the potential for increased risk to the Deposit Insurance Fund in situations where there is a significant degree of dependence by the industrial bank on the parent company or affiliates, particularly with respect to the primary business functions of the proposed institutions. Business models where there is significant or material dependence by the industrial bank on the parent company, referred to as shell or captive structures, raise significant concerns about the viability of the industrial bank's proposed business model on a standalone basis, the industrial bank's franchise value, in the event the parent organization experiences financial difficulty or failure, and how such business models serve the convenience and needs of the community. The FDIC's experience during the 2008-2009 financial crisis demonstrated that business models involving an insured depository institution inextricably tied to and reliant on the parent or its affiliates may create significant challenges and risks to the Deposit Insurance Fund, especially in circumstances where the parent entity experiences financial stress. Where an industrial bank is significant and reliant on and interconnected with its parent for generating business on both the funding and lending sides of the balance sheet, as well as for crucial operational systems and support, financial difficulties at the parent could be transmitted to the dependent industrial bank. Accordingly, the proposed rule sets forth important clarifications regarding criteria that the FDIC would consider when assessing the risks presented to an industrial bank by its parent organization and evaluating the industrial bank's ability to function independently of the parent. The proposed amendments would provide that an industrial bank will be presumed to be a shell or captive institution if it couldn't function independently of the covered parent company, is significantly or materially reliant on the covered company or its affiliates, or serves only as a funding channel for an existing covered company or affiliate business line. The FDIC will presume that the shell or captive nature of an industrial bank will weigh heavily against resolving one or more of the applicable statutory factors. For example, the evaluation of the convenience and needs of the community statutory factor is a broad inquiry, not limited to the Community Reinvestment Act. In assessing whether the convenience and needs of the community are met in industrial bank proposals, the FDIC will consider the customer base that the applicant intends to serve with its deposit and credit products and the market need filled through those products. As described in the preamble, when an industrial bank proposal is presumed to be a shell or captive, the target market may be such that the institution's products are only available to customers of an affiliate or to a limited part of the community. A business model that does not broadly serve the convenience and needs of the community may raise concerns about whether the community is being served by the proposed institution in a manner that supports the grant of deposit insurance. The FDIC will review each filing on a case-by-case basis, and the FDIC will allow any person seeking to rebut the presumption of a shell or captive structure an opportunity to present its views in writing. Given the unique nature of industrial banks and the facts and circumstances of a particular transaction, the NPR notes that the FDIC may also consider whether public hearings would be an appropriate means to obtain further public input on whether a specific application meets the convenience and needs of the community. The proposed amendments would also clarify the relationship between written commitments and the FDIC's evaluation of the statutory factors applicable to an industrial bank filing. Part 354 requires a covered company and industrial bank to make certain commitments, including entering into parent company agreements and capital and liquidity maintenance agreements in connection with the FDIC's approval of an application or non-objection to a notice. However, the proposed amendments reaffirm that these commitments and agreements will be taken into account as part of the FDIC's consideration of the underlying filing, but do not replace any statutory factor applicable to the filing and will not necessarily lead to the favorable resolution of any statutory factor where the facts and circumstances are otherwise unfavorable. This is consistent with the FDIC's longstanding applications processing policy. The proposal would also make several necessary revisions to the scope of Part 354 to expressly include filings related to a Federal Savings Association converting to a state bank, ensure that a parent company of an existing industrial bank would be subject to Part 354 if there is a change of control at the parent company or a merger in which the parent company is the resulting entity, and provide the FDIC the regulatory authority to apply Part 354 to other situations where an industrial bank would become a subsidiary of a covered company. Additionally, as noted in the preamble, the FDIC Board of Directors may release a statement in connection with decisions on applications and withdrawals. The proposed revisions to the rule would clarify and enhance the supervisory framework that the FDIC formalized in Part 354 to supervise industrial banks, to mitigate risk to the Deposit Insurance Fund, and provide necessary transparency for market participants. Accordingly, I support publication of this NPR and look forward to receiving public comment, and I would like to thank the FDIC staff for their thoughtful and diligent work on this NPR. Thank you. Vice Chairman.
Thank you, Chairman. Industrial loan companies and industrial banks, referred to as ILCs, first arose in the early 20th century. In the early years, ILCs were small, focused on serving industrial workers, and not insured by the FDIC. Although the FDIC approved deposit insurance for a few ILCs beginning in 1958, FDIC insurance became much more common for ILCs following changes to federal and state law in 1982. In 1987, Congress expressly exempted FDIC-insured ILCs from the Bank Holding Company Act's definition of bank, which meant commercial companies could establish or acquire ILCs without being subject to the BHCA's restrictions on commercial activities. The ILC exemption has raised several challenging policy questions, the most notable of which exploded into view when Walmart applied for an ILC charter in 2005. The FDIC ultimately never made a decision on Walmart's application for deposit insurance and instead imposed 2 moratoria on ILCs more broadly before Walmart eventually withdrew its application. In my opinion, the question of how the FDIC would approach an application for FDIC insurance from a very large commercial company, such as a retailer or technology company with customers in virtually every county in the country, is the elephant in the ILC room. Given the gravity of the policy issues at play, I think it would make sense for the FDIC to engage in a thoughtful, deliberative policymaking process to provide transparency around how we might approach this and other ILC-related questions. The proposal today addresses a different question, that of how the FDIC should approach applications from ILCs that are entirely dependent on their parents, which the proposal refers to as captives or shells. While this is a reasonable question to ask, it is an odd place to start, other than the fact that we have had several such applications recently, including one that withdrew last month after a 3.5-year wait. I describe this as odd because it suggests that a commercial company that seeks to establish or acquire an ILC might get approved if it wants a full-service bank, but there is a presumption of disapproval if it only serves the parent or affiliates or customers of the parent or affiliates. Said differently, there would be a presumption of disapproval if a large retailer sought an ILC charter to serve only existing customers of the parent, but no such presumption if it expanded the proposed charter to serve existing customers and more. Furthermore, if one of the recent applicants proposing a captive model had tried to cure the concern around captives by expanding its business model to serve a broader customer base, would the FDIC have approved it? I am skeptical. I appreciate the spirit behind the proposal and the desire to provide more clarity around the FDIC's approach to ILCs. However, I think we should have taken a step back and started with a broader request for information or advance notice of proposed rulemaking. I would have asked a broader set of questions, addressed a broader set of issues, and approached it all with a more open mind. While these issues are not new, and the FDIC has been grappling with ILC issues for multiple decades, I think there still would be benefit in starting with a clean sheet of paper and soliciting feedback in a more open-ended way. I think our ultimate objective should be a policy statement or similar document that provides more clarity to the public on how we interpret the statutory factors in the ILC-specific context and how that might apply with respect to certain types of applications, rather than a rule focusing narrowly on one specific model. Regardless, arriving at conclusions on some of the big policy issues and communicating those conclusions to the public is generally a much better approach than waiting until applications come in and sitting on those applications for years. I appreciate the concerns prompting the proposal today and the concerns with the ILC charter more broadly. Nonetheless, I will vote no, as I would have preferred to address the ILC issue in a more holistic manner. Finally, I want to thank staff for their work on the proposal.
Thank you. Director McKiernan.
Thank you, Chairman. We have a long day ahead, so I'll be brief and have a longer statement for the record. Just 2 quick points. One, my 1.5 years here, it's quite clear to me as we were considering some of these ILC applications that we had a bias against captive ILCs. Maybe that's appropriate, maybe it's not. We hadn't been transparent about that. So in that sense, I'm happy to see us add some transparency. It's maybe arguably overdue. Second point, while we're adding some transparency, we're saying we have a presumption against captive ILCs, we say things like we have a presumption that a captive ILC will not find favorably on one or more statutory factors. Well, which factors and why, right? We need to be transparent about that. And we say, we'll give an opportunity to rebut the presumption on one or more of those factors. How? I mean, it's customary when we have a presumption that you clarify how you rebut the presumption, how the framework would work, right? We're not providing that. So it's, on the one hand, it's a good step forward, maybe. I'm looking forward to comments on what it amounts to a very significant change in policy and whether that's consistent with the law. But on the other hand, I think we really needed to go further to provide that true transparency. So I'll be a no on the proposal, but I look forward to comments.
Thank you. Director Sue?
Sure. I support the proposal for the transparency reasons highlighted by Director McKiernan. I do want to take up Vice Chair Hill on his offer to engage on the broader policy issues. I do think we do need to have a real discussion on the separation of banking and commerce and kind of the role of both, not just the ILC, but other avenues, because that poses a whole host of questions and potential risks to the system, which do require quite a bit of engagement. I don't see that as mutually exclusive or contrary to what we're considering here today, so I support the proposal and look forward to having those conversations.
Thank you.
Well, thanks everybody for all of the work on this proposal. I do want to echo some of my colleagues on this about transparency. I actually do think that what we have done here in many ways is making clear what we should be doing in terms of interpreting the statutory factors. As I've shared before, I have huge concerns, and I know that is shared by others on this, about really the banking agency's reluctance to deny facially deficient applications. And one of the reasons some of these applications sit for so long is because they cannot get approved, but we do not necessarily deny them in a timely fashion. In my statement that I'll submit for the record, I have discussed my own concerns with 2 public notifications of withdrawals, one related to the proposed bank by Edward Jones, and another related to a proposal by General Motors. Both of them had very serious facial deficiencies, and I really appreciate all the thinking we've been doing together to make sure they don't just sit around and those applications get promptly denied, and that we are able to clearly explain the factors as to why they were denied. I think this rule will help us get to that point where, one, we are not going to see applications that are so facially deficient and that we have to expend our limited resources on it. So I really appreciate this, and I'll be voting in favor.
Good, thank you. There are no further comments or questions. May I have a motion to approve the resolution regarding proposed amendments to the regulations governing parent companies of industrial banks and industrial loan companies?
So moved.
Thank you. And a second?
Second?
I'll now call the roll for the resolution. I vote aye. Vice Chairman Hill?
No.
Director McKiernan?
No.
Director Sue?
Aye.
Director Chopra?
Aye.
Thank you. The motion is adopted. And thanks to the staff.
Marty, do you mind if I just use the restroom real quick? I'm sorry.
Quick break. We'll resume our meeting. Next on the agenda, we'll hear from staff regarding a proposal for a publication of a request for information on deposits. Ashley Mahalik, Kayla Shoemaker, and Ryan McCarthy will present the case.
Well, good morning, Chairman Grunberg and members of the board. Today, we are providing for your consideration a request for information, or RFI, seeking comments on deposit data, including data on uninsured deposits that are not currently reported in the call report or other regulatory reports. Runs of uninsured deposits, exacerbated by high reliance on uninsured deposit funding and concentrations in the depositor base, directly contributed to the spring 2023 failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. These events renewed focus by financial regulatory agencies, banks, investors, and the public on deposit insurance coverage, bank funding concentrations, and certain banks' reliance on uninsured deposits. A bank's liability structure can reflect its risk-taking behavior, and information about an institution's funding base is important in evaluating liquidity risk and interest rate risk. The experience of spring 2023 demonstrated that depositors may be able to move funds extremely quickly in the event of a bank's deteriorating financial condition or negative media attention. Deposit data are also important for receivership purposes, as the presence of deposit insurance coverage has direct implications for the costs associated with resolution of a failed institution. While banks are required to provide certain data on deposit liabilities on the call report, they do not report comprehensive data on the composition of insured and uninsured deposits. With this RFI, staff seek to further evaluate whether and to what extent certain types of deposits may behave differently from each other, particularly during periods of economic or financial distress. Additional deposit data also would inform analysis of the benefits and the costs associated with the additional deposit insurance coverage for certain types of deposits. So in May 2023, following the bank failures, the FDIC published a comprehensive report entitled Options for Deposit Insurance Reform, outlining 3 options to reform the nation's deposit insurance system. One of the options would provide additional coverage to a certain type of account, business payment accounts, but a significant challenge to establishing such coverage is deciding how broadly or narrowly to define these accounts. To inform discussion around any potential increases in deposit insurance coverage, which would require an act of Congress, the request includes questions on the definition of business payment accounts and any burdens or challenges associated with reporting new deposit data items, such as business payment accounts or similar accounts that are linked to payroll, vendors, or operations. Only banks with $1 billion or more in total assets report the estimated amount of uninsured deposits on the call report each quarter. And on an annual basis, all banks also report one subset of uninsured deposits, which are preferred deposits, which is the only type of collateralized deposit reported on the call report. And while banks report some types and characteristics of deposits on the call report, they do not report more granular data on insured or uninsured deposits. Certain institutions report information on deposit liabilities through other information collections, but reporting requirements for most of these data collections are limited to the largest institutions or a certain subset of banks and are not always publicly available. Through this RFI, staff seek comments on characteristics that affect the stability and franchise value of different types of deposits, and whether more detailed or more frequent reporting on these characteristics or types of deposits could enhance off-site risk liquidity monitoring, inform analysis of the benefits and costs associated with additional deposit insurance coverage for certain types of deposits, improve risk sensitivity of deposit insurance pricing, and provide analysts and the general public with accurate and transparent data. The RFI solicits comments from all interested parties, including but not limited to banks, depositors and financial consumers, businesses that utilize various types of payroll and payment accounts, consumer groups, researchers, trade associations, and other members of the financial services industry. Staff recommend that the board approve and authorize publication of the request for information on deposits with a comment period ending 60 days after publication. Thank you for your time, and we're happy to take any questions.
Thank you very much. That was very helpful, and I think this is actually an important proposal, so thank you for your work on it. I'll have a brief statement and then turn to the other members of the board. The FDIC Board is considering today a request for information on the composition and characteristics of deposits, particularly uninsured deposits, in concentrations of deposit types, which could affect the behavior of depositors in times of stress. Runs of uninsured deposits directly contributed to the failures of Silicon Valley Bank and Signature Bank in March of last year, and the subsequent failure of First Republic Bank, all large regional institutions. These runs were exacerbated by each bank's heavy reliance on uninsured deposit funding and concentrations in the depositor base, among other factors. While banks are required to provide certain data on deposit liabilities on the call report, they do not report comprehensive data on the composition of insured and uninsured deposits, nor the characteristics of those deposits. As a result, the FDIC doesn't have historical data on banking industry trends for different types of insured and uninsured deposits, including how depositors behave during times of stress. This request seeks information on the characteristics that could affect the stability and franchise value of different types of deposits. The request also seeks comment on whether more detailed or frequent reporting on these characteristics or types of deposits could inform a number of policy objectives, including enhancing off-site risk and liquidity monitoring. A bank's liability structure can reflect its risk-taking behavior, and information about an institution's funding base, including data on deposits, is important in evaluating liquidity risk and interest rate risk. A deposit insurer with responsibility for resolving failed insured depository institutions and managing the deposit insurance fund, the FDIC would benefit from more granular and more frequent reporting of deposits. Deposit data are important for receivership purposes, since the presence of deposit insurance coverage has direct implications for the costs associated with the resolution of a failed institution. Data on deposits also inform the FDIC's management of the deposit insurance fund, which is used to insure deposits, protect depositors of insured banks, and resolve failed banks. In an effort to better inform analysis of deposit balance trends, the request includes questions on how banks measure or evaluate the stability of different types of deposits and on what additional data, including more granular or frequently reported data, should be considered for collection. Other regulators and stakeholders also may benefit from that additional information. The request includes questions on whether more detailed or frequent reporting on characteristics or types of deposits can improve the accuracy and transparency of data reported on the call report or other regulatory reports to better inform analysts and the general public. Additional data on deposits would also inform the analysis of the benefits and costs associated with additional deposit insurance coverage for certain types of deposits. As was noted in May of last year, the FDIC published a comprehensive report, Options for Deposit Insurance Reform, outlining 3 options for Congress to consider to reform the nation's deposit insurance system. To inform discussion around any potential increases in deposit insurance coverage, the request includes questions on those options, including the definition of business payment accounts and any challenges associated with reporting new deposit data items on accounts linked to payroll, vendors, or operations. I'd like to thank the FDIC staff for their very thoughtful work in developing this request. I support publication of this request for information on deposits for public comment, and strongly encourage comments from all interested parties, which I think will greatly benefit and inform us. I look forward to receiving thoughtful comment on the request. And again, thank the staff for their thoughtful work on this. Vice Chairman Hill.
Thanks, Chairman. I have a short statement. I am supportive of the RFI. I think soliciting input on the behavior and characteristics of different types of deposits, including in particular differentiating among types of uninsured deposits, is a helpful step by the agency. More generally, I think regulators need to think more holistically about the deposit landscape than we do today, and I view this RFI as a small step in the right direction. In the long run, we should consider whether, how, and to what extent to collect more granular and frequent deposit data, and I think asking for broad feedback before proposing specific call report changes is useful. Finally, while any potential deposit insurance reform would ultimately be decided by Congress, I think seeking input from the public on the issue is constructive. Thanks.
Thank you. Director McKiernan.
Thank you, Mr. Chairman. I'll be supporting the proposal, and I'll have a statement for the record. Thank you.
Great, thank you. Director Sue.
The deposit landscape has changed a lot in recent years, and I think it's driven in part by digitalization. We've had conversations about this earlier. I do think not all deposits are created equal, and from a bank liquidity risk perspective, some are riskier than others. Our regs need to better differentiate between them. So I think this RFI really does start to move us in that direction. I am particularly focused on the need for more standardized differentiation between operational and non-operational deposits. That concept was quite common prior to all the focus on uninsured deposits starting last year. That challenge, differentiating between operational and non-operational, if surmounted, presents a significant opportunity to improve financial stability and the effectiveness and efficacy of regulation. I encourage commenters to propose approaches that can differentiate between operational and non-operational deposits consistently, transparently, and credibly across a wide range of banking business models. So with that, just thanks to the staff for their hard work on this, and I support the RFI. Thanks.
Thank you. Director Chopra.
Thanks for all the work on this. Nothing to add. I appreciate it.
Great, thank you. There are no further comments on this. May I have a motion to approve the resolution regarding the RFI on deposits?
So moved.
Thank you. And a second?
Second.
Thank you. I'll now call the roll for the vote on the resolution. I vote aye. Vice Chairman Hill.
Aye.
Director McKiernan.
Aye.
Director Sue.
Aye.
Director Chopra.
Aye.
The motion is adopted. Thank you. Thank you all very much. Thank you to the staff. Next on the agenda, we'll hear from staff regarding recommendations for 2 notices of final guidance on resolution plan submissions for triennial full filers and an extension of the submission deadline. Rob Connors and Dina Kessler will present the case.
Chairman Gruenberg and members of the board, my comments today pertain to Dodd-Frank Act, Title I, Resolution Planning Guidance. Staff recommends the board approve. This guidance would apply to the domestic triennial full filers through one document and the foreign triennial full filers through another. FDIC staff prepared this guidance together with the Federal Reserve with the intent of recommending the documents to both boards. I would like to first share 3 reasons why this guidance is important. Then I will highlight some of the components of the guidance. The first reason this guidance is important is to ensure future resolution plans are strengthened by incorporating lessons we learned just last year. The 2023 failures of certain large insured banks illustrated that such failures may have serious adverse effects on financial stability in the United States. And several of the companies that will be covered by this guidance operate large insured bank subsidiaries that are equal to or even greater in size and complexity than those that failed in 2023. Second, this guidance is important to address the risks posed by large foreign-based banking companies. Several of these firms conduct meaningful operations in the United States and have the potential to present risk to U.S. financial stability. The experience with Credit Suisse and the firm's liquidity and capital adequacy challenges illustrates the firms can fail faster and in ways not previously anticipated, adding to difficulties in procuring capital and liquidity that can exist in even anticipated stress conditions. This guidance will help foreign-based companies better prepare for the possibility of a resolution in the United States without disrupting U.S. financial stability. Finally, this guidance is important because our review of the last plan submissions submitted by this group of companies revealed that these firms would benefit from additional general direction. Staff's review of the 2021 targeted resolution plans revealed inconsistencies in the amount and nature of information provided by this group of companies in several important areas. And some companies simplified their resolution plans by including optimistic assumptions that may not be present in an actual resolution event. The proposed guidance would assist the firms in developing their resolution plans so that they could be executed under conditions as may be present in an actual resolution event, which would lessen the risk that the failure of one of these companies could cause adverse effects on U.S. financial stability or necessitate the use of the systemic risk exception or other means of extraordinary government support to avoid systemic disruption. I'll now address certain key components of the guidance. The guidance was largely derived from guidance issued previously to the U.S. GSIBs, but with modifications. The first type of modification is that while the U.S. GSIB guidance contemplates only a single point of entry approach to resolution, the proposed guidance for the triennial full filers provides the option of using either the single point of entry or the multiple point of entry approach to resolution. Staff recommends that the board maintain the FDIC's long-standing practice of not prescribing a firm's Title I resolution plan strategy. Whether to use a single point of entry resolution strategy, also known as SPOE, or a multiple point of entry resolution strategy, known as MPOE, should be the firm's choice and should reflect its comprehensive assessment of its organization, operations, capabilities, and the risks its failure might present to financial stability. The separation of the guidance for the two general approaches to resolution is to make it clear that both SPOE and MPOE approaches are acceptable strategy choices, while also recognizing that they have different vulnerabilities and require different types of planning and different capabilities. This guidance would state explicitly that the agencies are not identifying preferred strategies for any firms, nor are the agencies suggesting any firm should change its resolution strategy. The second type of modification is that staff accounted for the differences in characteristics and the reduced complexity between these firms and the U.S. GSIBs, and the lessened need for certain information for firms that select MPOE strategies. For example, the SPOE guidance includes certain complex and sophisticated capital and liquidity prepositioning and execution concepts to help ensure that subsidiaries stay open and operating during the resolution process that are not necessary for MPOE strategies and so are excluded from the MPOE guidance. Governance mechanisms, including triggers that are integral to the proper timing of a bankruptcy filing in an SPOE strategy, are not included as expectations of domestic firms' resolution plans that use a MPOE strategy, and the governance mechanisms guidance for FBOs that use an MPOE strategy are significantly simpler than for those that use an SPOE strategy. And third, the topic of derivatives and trading activities is not addressed in this guidance for either strategy because the triennial full filers have limited derivatives and trading activities, and relative to those limited activities, the topic is sufficiently addressed by the joint Title I Resolution Plan rule. Several of the triennial full filers conduct their operations primarily through insured depository institutions, or IDIs, and have selected an MPOE strategy. Therefore, I'd like to take a few moments to comment on matters pertaining to bank resolution. In June 2024, the board approved the revised IDI Resolution Planning Rule. The IDI Resolution Planning Rule and the Dodd-Frank Act Title I rule are complementary, but they are not the same. The FDIC IDI Resolution Planning Rule assists the FDIC in preparing to resolve a large insured bank. By contrast, Dodd-Frank Title I Resolution Planning assesses the firm's plan for its resolution in a manner that substantially mitigates the risk that its failure would have serious adverse effects on financial stability in the United States. It is important to remember that the regional bank failures of March 2023 demonstrated that the failure of IDIs that are even smaller and less complex than the triennial full filers can be disruptive to U.S. financial stability. When an IDI fails and the FDIC is appointed receiver, the FDIC generally must use the resolution option for the failed IDI that is the least costly to the deposit insurance fund of all possible methods. Therefore, if a firm uses an MPOE strategy that calls for resolving an IDI with a strategy other than payout liquidation, the plan needs to acknowledge that the least cost resolution constraints in an appropriate manner to provide comfort that the strategy is workable. In other words, the plan should explain how the requirements of the Federal Deposit Insurance Act could be met without depending upon extraordinary government support, such as the systemic risk exception that was necessary in March 2023. If a resolution plan does not provide such an explanation, it may be appropriate to conclude that the strategy would not satisfy the FDI Act's provisions, which could represent a weakness in the plan. It is important to note that the final guidance does not include an expectation that the firms provide in their resolution plans a complete least cost analysis. Such an analysis would include a comparison of the preferred strategy for resolving the IDI against every other possible resolution method. While a firm may choose to provide a complete least cost analysis, this guidance discusses alternative approaches that could also illustrate that the firm's preferred strategy is not more costly than a payout liquidation. The final guidance includes additional information regarding a number of approaches to resolving an IDI and describes the kind of information that firms could use to support their resolution strategy, including a step-by-step illustrative example of one of these approaches. I previously referenced that certain liquidity and capital execution and pre-positioning concepts are essential to a successful SPOE strategy. I'd like to specifically address the inclusion of those two components of this guidance regarding SPOE strategies. These are resolution capital adequacy and positioning, or RCAP, and resolution liquidity adequacy and positioning, or RLAP. The failures of March 2023 demonstrated that the effects of stress events can evolve rapidly. The successful execution of an SPOE strategy is less likely to be successful under a short time frame without advanced planning that includes the appropriate positioning among the firm's material entities of loss-absorbing instruments and liquidity to continue operations. RCAP and RLAP are designed to address this weakness, with RCAP facilitating the appropriate positioning of capital and other loss-absorbing instruments among the firm's material entities, and RLAP helping firms maintain sufficient and appropriately positioned liquidity to continue operating subsidiaries during resolution. In 2020, the concepts of having mechanisms to measure and pre-position resolution capital and liquidity in the United States were removed from resolution planning expectations applicable to a small group of foreign-based firms in deference to internal stress testing, other regulatory requirements such as total loss absorbing capacity, or TLAC, and the liquidity coverage ratio, or LCR, as well as the reduced size and complexity of those firms in relation to what had been their size and complexity a few years earlier. We have since learned that those factors alone are incomplete safeguards. For example, Credit Suisse failed in March 2023, even though it operated with liquidity and capital positions well above regulatory minimums just a few months earlier. Also, neither the TLAC requirements nor the LCR and NSFR liquidity standards apply to each material entity, and they do not fully account for potential inter-affiliate frictions. Finally, while stress testing is a valuable tool to help dynamically measure an institution's vulnerability to stress and to promote resiliency, stress tests typically do not directly support resolution preparedness. Separate from the content of the guidance, staff recommends that the board extend the due date of the next resolution plans to October 1st, 2025. By adopting this date, the firms will have the benefit of 1 year after the expected publication date to implement the guidance and develop their next resolution plan submissions. This concludes my remarks, and we will be happy to respond to any questions you may have.
Thank you very much. I have a brief statement, and then I'll turn to the other members of the board. The Dodd-Frank Act established a statutory requirement for certain companies to develop plans for their rapid and orderly resolution. The FDIC Board is considering today issuing final guidance jointly with the Board of Governors of the Federal Reserve regarding resolution plans required under Title I of the Dodd-Frank Act for certain companies, generally with assets greater than $250 billion. In particular, this guidance would apply to the so-called triennial full filers, a group that includes the largest regional banks. The implementation of the Title I rule has been an iterative process aimed at strengthening the resolution planning capabilities of financial institutions subject to the rule. To assist covered companies in developing their resolution plan submissions and operational capabilities, the agencies have provided feedback on individual plan submissions, issued guidance to certain groups of covered companies, and issued answers to frequently asked questions. The agencies have not, however, thus far issued guidance to domestic triennial full filers or most of the foreign-based triennial full filers. Guidance doesn't carry the force of law, and it's not institution-specific, but it can help focus the efforts of similarly situated covered companies to improve their resolution capabilities and clarify the agency's expectations for those filers' future progress in their resolution plans. The guidance the board is considering today draws upon guidance the FDIC and Federal Reserve previously issued to the U.S. global systemically important banking organizations and certain large foreign banks, but also makes appropriate modifications for the structure and complexity of this group of firms, incorporates observations drawn from analyzing prior resolution plan submissions from the triennial full filers, and reflects lessons learned from the failures of March 2023. Important matters addressed within this guidance include the following. The agencies are continuing the historical practice of not prescribing a specific resolution strategy for any firm. Each company remains free to choose the strategy it believes would most effectively facilitate a rapid and orderly resolution. The attention paid to the multiple point of entry strategy in developing this guidance should be understood as a clear statement that selection of such an approach to resolution remains a viable option. The single point of entry and MPOE resolution strategies address different vulnerabilities and require different planning and different types of capabilities. This guidance recognizes those differences and provides expectations that reflect those differences. Finally, the failure of a large regional bank can present the risk of disruption to U.S. financial stability. Many of the companies subject to this guidance operate insured bank subsidiaries that are larger and more complex than those that failed in 2023 and necessitated the use of the systemic risk exception. It is essential that all covered companies develop resolution plans that allow for their orderly and rapid resolution without depending on extraordinary government action or taxpayer support. This guidance will help ensure that the triennial full filers develop appropriate resolution plans to mitigate the risk that their failure could have serious adverse effects on U.S. financial stability. I support the guidance as well as the extension of the next submission date so that covered companies can fully consider the guidance. I'd like to thank the staffs of both the FDIC and the Federal Reserve for their efforts in collaborating to develop this guidance and to help improve the resolvability of large regional and foreign banks. Thank you. Vice Chairman Hill.
I plan to vote in favor of the final Title I resolution plan and guidance for domestic and foreign triennial full filers. I agree with the decision not to provide specific guidance on derivatives and trading activities, given the relatively small size of these activities for triennial filers. And I appreciate the agency's clarification that foreign triennial filers are not expected to include information about their global resolution plans when such firms do not have access to those plans. Additionally, I support the extension of the next resolution plan submissions for these firms until October 1st, 2025, which is consistent with the agency's commitment under the rule to provide at least 1 year following the finalization of any guidance. Although I will vote in favor of the final guidance, I do have a few reservations. I think we may want to revisit this guidance in the future, depending on whether and how the proposed long-term debt is finalized. Relatedly, at some point, it may be worth exploring an SPOE light approach for non-GSIBs with an SPOE resolution strategy. I also continue to have some skepticism of requiring firms with an MPOE resolution strategy to explain how an IDI resolution would comply with the least cost test, given that we have a separate resolution planning rule governing IDIs and given the substantial uncertainty around trying to estimate the cost of resolution options at the time of failure. Nonetheless, I plan to vote in favor of the guidance and would like to thank the staff for their continued work on the issue.
Thank you. Director McKiernan.
I'll have a statement for the record, but I'll just say that I am going to also support the guidance. Maybe arguably this is the most important thing we'll do today. The lesson I take from our bailouts last March 2023 is that we really got to have a credible resolution framework for all large banks, and I think this is an important step in that direction. So thank you to the staff, and I'll look forward to supporting.
Good. Thank you. Director Sue.
Thank you, Chairman. I do have one question for staff. I'd like to confirm the intent of the guidance as it relates to divestiture preparedness. For the GSIBs, under the Title I guidance, there's a separability requirement. That's kind of the phraseology that's used. And I noticed that that phrase is not used here. I think there are other phrases that are used. I just want to confirm that it's not the intent to suggest that the Cat 2 and 3 firms can do less by way of preparation.
Thank you for the question, and you're correct. Developing actionable separability options is essential for any type of resolution. In the absence of the guidance for the domestic companies directly addressing the topic should not be inferred or interpreted as lessening its importance. In fact, the Title I rule, it actually requires that the plans address the feasibility of executing any divestitures that might be required as part or that are built into the strategies, and also considering what the implications of those divestitures are for ongoing operations. And nothing we're saying today or in the guidance would alter those expectations either. Just a little bit more, the guidance to the GSIBs in 2019, that in part reflects the fact that they conduct business activities across multiple legal entities and can cross international borders. And that can make their operations become very intertwined and difficult to detangle. And so the guidance to the GSIBs helps with that process, whereas most of these companies are, or many of these companies are IDI-centric. They don't have the multiple legal entity challenge. And then lastly, in the IDI resolution planning rule, there are concepts conveyed there around requiring each institution to be able to identify separable franchise components, what may be marketed, how it may be marketed, and the challenges that may exist in doing so. And what we tried to do is maintain harmony between how we approach this guidance document and what we've requested in the IDI rule. So it certainly is not meant to lessen anything.
Great, that's great to hear. So I support the final guidance with that. Last year's large bank failures highlighted the risks of over-tailoring, i.e. under-calibrating the resolvability requirements for non-GSIB large banks. This final guidance is one of several steps addressing that risk. All banks need to be resolvable. For large banks, this means, among other things, being prepared and able to divest material lines of business and portfolios, and this final guidance helps ensure that. I also support the extension of the firm's resolution plans to due dates to September 30, 2025, and I want to thank staff for their great work on this. Thank you.
Thank you, Director Chopra.
Thank you again, and for the purposes of time, just want to extend my gratitude, and I'll support the resolution.
Great, thank you very much. If there are no further comments on this case, may I have a motion to approve the resolution? Thank you. May I have a second? I'll now call the roll on the resolution. I vote aye. Vice Chairman Hill?
Aye.
Director McKiernan? Aye. Director Sue?
Aye.
Director Chopra?
Aye.
The motion is adopted. Thank you all. Finally, the last item on our agenda, this open agenda this morning, the board will consider two resolutions related to the Change in Bank Control Act regulations and procedures. We'll hear presentations on both resolutions first. Board members will then have the opportunity to ask questions and present statements on these resolutions. Once all discussion is completed, the board will vote on each resolution separately. I believe Director Chopra will present the first resolution.
Great. Well, thank you all so much. In a previous board meeting, we had discussion about our policies with respect to the Change in Bank Control Act. I really appreciate all the conversations over the past few months for us to have a path forward on this. Today, I will put forth a resolution for a proposed rule that would change our approach when it comes to reviewing changes in bank control. As a companion to this proposed rule, I'm pleased that the FDIC will also be notifying certain firms about additional oversight with respect to so-called passivity agreements on future acquisitions and changes in control. The FDIC's existing rules include an odd provision that in practice eliminates the agency's review of changes in control for many covered transactions involving insured banks. I think it's highly inappropriate for the FDIC to abdicate the responsibility Congress entrusted to us to safeguard the ownership and control of the banks we supervise. I'm asking the board to adopt a proposed rule that would simply delete the exemption from the notice requirement for acquisitions of voting securities of a holding company with an FDIC supervised subsidiary for which the Federal Reserve Board of Governors reviews a notice under the Change in Bank Control Act. It will be very important to coordinate with the Fed and the Office of the Comptroller of the Currency as we revise our approach. The banking industry and the public would benefit from a consistent and uniform approach to this law. The notice I am putting forth for board adoption would also launch a broader inquiry into very large asset managers that are accumulating increasingly large stakes in companies across the economy, including banks. Other agencies across government are also evaluating similar trends across sectors. For example, two asset managers, BlackRock and Vanguard, collectively control over $17 trillion in these assets. They now own large enough shares in many banks to trigger statutory guardrails and limitations. These firms assert they are passive and do not actually control the banks they own. So they have entered into so-called passivity agreements with regulators to avoid these requirements. For example, under the Federal Reserve's 2020 rule changes and under some existing passivity agreements, these asset managers can still be considered passive even if they take a seat on the bank's board. Holding a seat on a firm's board of directors seems to be anything but passive. The proposed rule seeks comment on risks associated with this concentrated ownership, including with respect to conflicts of interest, financial stability, the effect on competition, and the efficacy of passivity agreements. In addition to the proposed rule, after further deliberation since April, I understand that we've now determined it's appropriate to notify certain firms that going forward, they can no longer rely on existing passivity agreements for direct or indirect investments in additional FDIC-supervised institutions that trigger the presumption of control. These investors, in my view, should either file a Change in Bank Control Act application or rebut the presumption of control. The FDIC will also seek information from other firms regarding their current investments and stewardship activities. If the asset management firms would like to rebut the presumption of control for these investments in additional banks, the FDIC will be open to this and including negotiating new agreements. In my view, and I know this is a sentiment expressed by some of my colleagues on the board, any new agreements should not rely on so-called self-certification as the exclusive or even primary means of ensuring compliance. We also need to think carefully about how the agreements address voting and other investor engagement with bank boards and management. Going forward, I think we should want to have access to the information necessary to verify that firms are not acting directly or indirectly in a controlling manner with respect to an FDIC-supervised institution if they have a so-called passivity agreement. I really want to thank the board, including the acting controller, for the discussions we've had about an interagency approach, Director McKernan for all his work and discussions on this, and I believe the actions that we will pursue are timely and important. Thank you.
Thank you. Director McKinnon will now present the second resolution.
Thank you, Chairman. Let me start by just expressing my very serious appreciation to Director Chopra for all his work on this and really getting us here today. I think this became a mutual interest of ours November, December last year over a lunch, and there's been a lot of back and forth on how to get this done. And I think it sounds like we're getting to a good place here. Just to briefly recap, it's my view that we need to have a program for monitoring whether some of these large, purportedly passive index fund complexes are actually exercising control directly or indirectly over FDIC-supervised institutions. And as Director Chopra suggested, I think he and I agree that it's important that this monitoring program should not rely on, or even primarily on, self-certifications of passivities. Self-certification is just not the way you do regulation. Achieving these goals, I think, can be achieved with two relatively incremental changes to our practices here at the FDIC. First, the FDIC has in recent years decided not to require these index fund complexes to deal with the FDIC with respect to indirect control at the bank level if that complex has passivity commitments with the Federal Reserve with respect to the holding company. We should, at the FDIC, be exercising our proper statutory role in these circumstances and taking a look at these potentially indirect controls. Second, our monitoring provisions need to come out with the self-certifications, and we should ensure that we have a more robust monitoring program in place. And so what my proposal would do is direct the FDIC to send to these purportedly passive index fund complexes a notice that says two things. One, after some date certain, the FDIC will require these fund complexes to comply with law by either filing a Change in Bank Control Act notice with respect to their large direct or indirect investments in FDIC-supervised institutions, or rebutting the presumption of control. Basically, this notice just says they need to comply with the Change in Bank Control Act after some date certain. Second, if the index fund complexes want to rebut that presumption of control through passivity commitments, the commitments will need to include provisions to facilitate monitoring by the FDIC. Basically, just no more self-certifications. So that's what the proposal does, just direct staff to send these notices to the passive index fund complexes. And I think then that gets us to a place where we're doing our appropriate job under the Change in Bank Control Act. But I'll look forward to hearing the thoughts of the other board members about maybe the right approach forward here. Thank you.
Thank you. We'll now turn to the rest of the board for comments. I'll have a brief statement and then turn to the other members. Today, the FDIC board is considering a notice of proposed rulemaking as proposed by Director Chopra, amending the FDIC's rules and regulations implementing the Change in Bank Control Act. Changes in bank control typically require a notice to be filed with the primary federal regulator. In certain situations, however, the FDIC has not required a notice. The proposed rule would remove that exemption and request further public comment regarding the FDIC's overall approach to changes in control affecting FDIC-supervised institutions. As Director Chopra's proposal makes clear, however, the FDIC recognizes the importance of interagency collaboration and consistency with respect to the review of these notices and is committed to engaging in dialogue and coordination with the Federal Reserve and the Office of the Comptroller of the Currency to develop an interagency approach to these issues. Generally, under the Change in Bank Control Act, no person acting directly or indirectly or in concert with others may acquire control of an insured depository institution without providing at least 60 days prior written notice to the appropriate federal banking agency. The FDIC's current regulations exempt change in control transactions from the FDIC notice requirement when the Federal Reserve Board reviews a notice for acquisition of control of the holding company of an FDIC-insured institution. This regulatory provision is in contrast to situations where the Federal Reserve has accepted passivity agreements from an investor in lieu of receiving a notice under the Change in Bank Control Act. In such cases, the FDIC previously has expressed that the agency would evaluate the facts and circumstances in order to determine whether a notice should be filed with the FDIC. In practice, however, the FDIC typically has not required such notices when the Federal Reserve Board accepts passivity commitments. I believe it is important that the FDIC, as the primary federal regulator of state non-member banks, closely review who is exercising direct or indirect control over its supervised institutions. The proposed regulatory change would remove the existing exemption and harmonize the FDIC's approach, giving the FDIC the ability to request a notice of change in control or negotiate passivity commitments with a proposed acquirer, notwithstanding whether the Federal Reserve Board reviews a notice or accepts passivity commitments pursuant to its legal authority with respect to depository institution holding companies. I do note, however, that the FDIC intends to strengthen its passivity commitments with investors by ending reliance on self-certification by investors and ensuring that the FDIC has the ability to obtain the information necessary for examination staff to analyze the ongoing interaction between an investor and the institution. As I emphasized at the outset, and want to make clear, the FDIC values and expects to continue its close collaboration with the Federal Reserve and the OCC on matters related to control affecting FDIC-supervised institutions and their respective holding companies. To that end, the NPR asks a number of questions and seeks comment on ways to potentially move forward on an interagency basis to ensure consistency and coordination in the review of notices under the Change in Bank Control Act. So in conclusion, the notice of proposed rulemaking under consideration offered by Director Chopra represents a meaningful shift in the FDIC's approach to proposed acquisitions under the Change in Bank Control Act. It would amend the FDIC's Change in Bank Control regulations to enable the FDIC to consider the full range of options available to it under the statute. Accordingly, I strongly support the proposed rule and look forward to the public comment we will receive. In regard to the proposal by Director McKiernan, I think we share common goals here. I'm open to the notifications. I don't think we need a board action to direct those notifications. So for that reason, I wouldn't support Director McKierman's proposal, but I think we are working in concert to try to address this issue. So let me thank both directors for their contributions here, as well as the staff who have worked thoughtfully and diligently on policy proposals addressing these issues for the board's consideration. Vice Chairman Hill.
Thanks. I'm going to vote no on both proposals. I agree strongly with the spirit of what originally brought us here, which is large, purportedly passive investors using their voting power to push for broader policy goals, which in certain instances included some politically divisive issues in America. I commend Director McKiernan for raising the issue and for pushing the conversation here at the board. I agree with the principle that we should ensure that large asset managers who own large stakes in banks are actually passive. I was and continue to be supportive of the monitoring proposal from April. I also would have been supportive of an RFI or an ANPR, which I know has been under some consideration over the past few months. As I said in April, I think seeking public comment on some of these issues could be useful. I continue to oppose the NPR due to skepticism of doing an FDIC-only rulemaking that would require a range of bank investors to file duplicative notices with both the FDIC and the Federal Reserve. I also think we should be cautious about measures that might result in asset managers reducing their investments in banks. If we send freeze letters, certainly the hope is that the result would be new agreements with monitoring provisions and/or stronger passivity commitments. But my concern is what would happen if we don't reach an agreement by the specified date. And I also am not totally sure that whatever resulted from those agreements would actually be a meaningful change in behavior from what we have today. So I think there's a lot of agreement here in terms of the objectives, but maybe some disagreement on the path.
Thank you. Director Su?
So I support today's proposal from Director Chopra regarding the change in bank control regulations and procedures. It strikes the appropriate balance between the FDIC's interest and the need for interagency collaboration and consistency in responding to changes in the market structure of bank ownership. Notably, the NPR includes a commitment by the FDIC to work with the Federal Reserve Board and the OCC to develop an interagency approach to what constitutes a change in control and how the notice and rebuttal processes should work. Should the agencies agree upon an approach, I would expect them to issue an interagency NPR prior to finalizing. So based on this commitment, I support that proposal. With regards to Director McKiernan's proposal, like Director Chopra and I think Chairman Grunberg, I'm committed to supporting stronger monitoring mechanisms with regards to passivity, provided they don't overly burden FDIC staff. The juice has to be worth the squeeze, as they say. I do have some questions about the process by which we do that. And we want to be sufficiently deliberative. We want to ensure that we get the details right and that we minimize the risk of unintended consequences. And for that reason, like the chairman, I'm not sure that the proposal as procedurally as proposed needs to be adopted. But I think I'm agreeing with kind of, I think everyone here that there's broad agreement on the objectives in the direction of travel. And so I think that that's worth putting out there. Thanks.
Thank you. Director Chopra, would you want
Yeah,
to?
let me just ask, I know the chairman mentioned, how he has been working with staff with respect to notifications of certain firms. We just wanted to see if you wanted to say anything else about timeline. My understanding was that that's in the very near term.
Yes.
Well, Mr. Chairman, if I might, in light of that, I hear the concerns raised, if I understood, by Director Sue and you, Chairman, around process. This is admittedly a fairly granular, weedy topic, right? And something that I think may be best driven at the staff level with candidly probably some iteration, some back and forth with some of these fund complexes to make sure they understand what we're trying to do and we appropriately tailor, calibrate our notices to them. That said, we have been, I think, talking about this issue and trying to get these notices out for 7-8 months now. And so I'm happy to table again the proposal here this week, but I will just say, if we don't get these notices out in short order, in very near term, I'm going to send around this for notational folks. I think we've talked about this for a long time. We've got to get progress on remediating what is a very clear gap in our framework for monitoring compliance with the Change of Bank Control Act. So with that, Mr. Chairman, if I might, I'll table my motion for now and look forward to the vote on Director Chopra's proposal.
Okay, thank you. No further comments?
Yeah, just to say, I think that's very reasonable, and I think we'll work to make sure that it occurs in very short order. And I think we're on the same page here, and I appreciate your willingness to work with staff on this. So you can ask now for trying to go quick with times.
Don't jump the gun on me.
Right.
There's no further comment from members of the board. May I have a motion with respect to the resolution presented by Director Chopra?
So moved.
And a second?
Second.
Thank you. I'll now call the roll for the vote. I vote aye. Vice Chairman Hill?
No.
Director McKiernan?
No.
Director Sue?
Aye.
Director Chopra?
Aye.
The motion is adopted. And with that, I think we have completed the agenda for our open board meeting today. I'd like to thank all the members of the board and thank all the staff for their excellent work in working through these cases today. And this open meeting is adjourned.